Before we dive in, a quick but critical disclaimer. I am not a licensed financial advisor, attorney, or accountant. This video is for educational and informational purposes only and should not be considered legal, financial, or tax advice. My goal is to demystify a complex document and empower you with knowledge. However, every situation is unique, and you should always consult with qualified professionals for advice specific to your circumstances. Think of this as your field guide. But your licensed expert is the one who helps you navigate your personal financial journey. Picture this. You're sitting at a closing table, a literal mountain of paperwork in front of you. Your hand is cramping. The title agent is sliding documents across the table. Your real estate agent is giving you a thumbs up. And the only thing standing between you and the keys to your new home is your signature. And you sign, and you sign, and you sign again. Buried in that stack, maybe 5 or 6 pages deep, was a document called the promissory note. You probably spent less than 90 seconds looking at it. But in that moment, you signed the single largest, most legally binding IOU of your entire life. You made a promise to pay back hundreds of thousands of dollars. Here's a terrifying statistic. A recent survey found that while over 65% of Americans are homeowners, fewer than 10% could correctly identify and explain the 3 most critical clauses in their own mortgage note. Let that sink in. 90% of homeowners, your neighbors, your friends, maybe even you, are legally bound to a contract worth a fortune. A contract that will dictate a huge part of their financial life for the next 30 years, and they don't truly understand the rules of the game. This isn't your fault. These documents are designed to be confusing. They're written by lawyers for lawyers. They're dense, they're filled with jargon, and let's be honest, they're incredibly boring to read. And the system relies on that. It relies on you being too overwhelmed, too excited, or too intimidated to ask the tough questions. It relies on you to just sign on the dotted line. This creates a massive information imbalance, where the lender holds all the cards, and you, the borrower, are left hoping for the best. Well, today that ends. The purpose of this video and this entire series is to shatter that imbalance. We are going to take that dense, intimidating document and translate it into plain, simple English. By the time we're done, you won't just be a homeowner. You'll be an educated, empowered financial consumer. You will understand your rights. You will understand your obligations. You will know exactly what you promised the bank and, just as importantly, what the bank promised you. You will be able to look at your mortgage note not with fear or confusion, but with confidence. Why does this matter so much? Because what you don't know can absolutely hurt you. Hidden inside that legal speak are clauses that determine everything. What's your real interest rate? Is it fixed or can it change? What happens if you're one day late on a payment? Are there penalties for paying your loan off early to save on interest? Can the bank demand the entire loan be paid back immediately for some obscure reason you're not even aware of? The answer to every single one of these questions isn't in some verbal agreement or a friendly handshake. It's written in black and white, in the fine print of your mortgage note. This document is the ultimate source of truth. It's the constitution of your loan. It is the rulebook that governs your relationship with the lender for the next 1,095 days or more. Ignoring it is like trying to play a high-stakes poker game without ever learning the rules. You might get lucky for a while, but eventually the house always wins. So let's start with the absolute basics. What exactly is this thing? When you buy a house with a loan, you're actually signing 2 separate, critically important documents. Most people lump them together and just call it the mortgage, but they serve very different purposes. The first document is the star of our show, the promissory note, or as it's often called, simply, the note. This is your promise. It's the IOU. This document is what makes you personally liable for the debt. It lays out the financial terms: how much you borrowed, the interest rate, your monthly payment amount, where and when to send the payments, and what happens if you fail to pay. If you were to borrow $100,000 from a friend and write the terms on a napkin, I, John Smith, promise to pay Jane Doe $100,000 plus 5% interest, that napkin would be a promissory note. It is a standalone contract for a debt. It has nothing to do with the house itself, only the money. The second document is what's called a security instrument. Now this is the one that gets a little tricky depending on what state you live in. In most states it's called a mortgage. In others it's called a deed of trust. For our purposes, they do the same job. This is the document that connects the debt from the promissory note to your actual physical property. It's the or else part of the loan. The security instrument says, hey, I promise to pay back all that money in the note. And to secure that promise, I am putting up my house as collateral. If I break my promise and stop paying, the lender has the right to take my house through a process called foreclosure to get their money back. Think of it like this. The promissory note is the bar tab. The mortgage or deed of trust is you handing the bartender your car keys as a guarantee that you'll pay the tab. The note creates the debt. The security instrument pledges your property as the guarantee for that debt. You need both to have a standard home loan. Without the note, there's no debt to pay. Without the security instrument, the lender has no claim on your house if you default. They just have to sue you personally like any other creditor. Understanding this distinction is the first and most fundamental step to decoding your loan. The note is about the money. The mortgage or deed of trust is about the house. And while we'll touch on the security instrument later in this series, our primary focus is on the document that people understand the least, but that dictates the financial mechanics of their loan for decades: the promissory note. Because within those few pages lies the entire blueprint of your financial commitment. It details the exact interest rate you'll be paying and, more importantly, how that interest is calculated and applied to your loan balance every single month. It contains the amortization schedule, the magic of how your payments are split between principal and interest over 30 years. It holds the secrets to late fees, how much they are and when they kick in. It contains a clause that many people don't even know exists, the prepayment penalty clause, which could actually punish you for trying to be financially responsible and paying off your loan ahead of schedule. And it contains the most powerful clause of all, the acceleration clause, the lender's nuclear option, which gives them the right to demand the entire loan balance be paid in full, immediately, under certain conditions. Over the next several parts of this series, we are going to walk through a standard U.S. mortgage note, section by section, line by line. I'm going to show you exactly where to find this information, how to interpret the legal language, and what it means for you and your money. We will turn this confusing legal document into a simple, understandable roadmap. You took the incredible step of buying a home. Now it's time to take the next step and become the master of your mortgage. So let's do it. Right now. If you have your mortgage documents handy, go grab them. If not, don't worry, I'll be walking you through a standard one. We're going to look at this thing together, line by line. The very first thing you'll see, usually right at the top in big, bold letters, is the title, Promissory Note. Don't just skim past that. Let those words sink in. Promissory note. This isn't just a contract. It's a promise. It's the modern equivalent of a blood oath, a solemn vow written not in ink, but in the life you're building. This is the heart of the entire agreement. Everything else, all the pages of legal essay that follow, is just the instruction manual for this single powerful promise. And what is that promise? It's stated right there in the first paragraph, and it's beautifully simple. In return for a loan that I have received, I promise to pay. That's it. That's the core of the whole deal. You receive something of immense value, the money to buy your home, and you are giving your word, a legally binding word, that you will pay it back. This section is your IOU to the lender, written on the most expensive piece of paper you'll probably ever sign. It establishes the debt, makes it real. Now let's look at the players in this grand drama. The note will clearly identify two key parties. First, there's you. The document will call you the borrower. It will list your name, or maybe you and your spouse's names, and your new address, the address of the property you just fought so hard for. This seems obvious, but it's critical. It's the part of the document that ties you personally to this promise. Then there's the lender. This is the institution, the bank, the credit union that put up the cash. Their name and address will be right there as well. They are the other side of this promise. Now here's a pro tip. A little piece of insider knowledge that confuses millions of homeowners. The name you see here as the lender might not be the name of the company you send your monthly payments to. Wait, what? How is that possible? Welcome to the world of mortgage servicing. The original lender, the one who gave you the money, often sells the right to collect your payments to another company. This company is called a servicer. So, while your promise is technically to the original lender, your day-to-day relationship is with the servicer. They send you the statements, they process your checks, they manage your escrow account. The note gives the lender the right to do this. It's a crucial distinction. Your legal promise is to the lender on the note, but your monthly check is written to the servicer. Understanding this difference can save you a lot of headaches and confusion down the road. Okay, so we've established the promise and the players. Now for the main event. The number that probably kept you up at night. The big one. Somewhere in that first section, you will see a dollar amount spelled out in words and written in numerals. This is the principal loan amount. This isn't the price of your house. This is the exact amount of money the lender gave you. Let's say your house costs $400,000 and you made a $40,000 down payment. Your principal loan amount on this note will be $360,000. This is the mountain. This is the starting line of your financial marathon. Every single payment you make for the next 15, 20, or 30 years is, in part, an attempt to chip away at this giant number until it becomes zero. It's the fundamental truth of your mortgage. But you're not just paying back the mountain. You're also paying for the privilege of borrowing the money to buy it in the first place. And that brings us to the most important number on the entire document besides the principal itself. The interest rate. The interest rate is the price of the loan. It's the rent you pay on the money you borrowed. It's the lender's reward for taking the risk on you. This rate, this single percentage, will have a bigger impact on your total cost and your monthly payment than almost any other factor. It's everything. And your note will spell it out very clearly, usually in a section titled simply, Interest. It will say something like, I will pay interest at a yearly rate of, followed by a percentage. Let's say it's 6.5%. This number dictates how much rent you're paying on that remaining principal balance every year. Now, this is where things can go in two very different directions, and you need to know which path you're on. Path number 1 is the fixed rate mortgage. If you have this, your note is simple. That's 6.5%. It's locked in. It will be 6.5% on day 1, and it will be 6.5% on day 10,950, your very last day of the loan 30 years later. It doesn't matter if the economy soars or crashes. It doesn't matter if the Federal Reserve raises rates to the moon. Your rate is your rate. It is predictable, it is stable, it is boring in the best possible way. A fixed-rate mortgage is like a contract with financial gravity. The rules are set and they do not change. For homeowners who crave stability and want to know exactly what their principal and interest payment will be every single month for decades, this is the gold standard. But there is another path. Path number 2, the adjustable rate mortgage or ARM. If you have an ARM, this section of your note is going to look a lot more complicated. And you need to pay even closer attention. An ARM is a shapeshifter. It's a financial chameleon. Starts one way, but it can change dramatically over time. Your note will first specify an initial interest rate. This is often called a teaser rate because it's usually lower than the fixed rates available at the time. It's designed to be attractive to draw you in. The note will say this rate is fixed for a specific period, maybe 3 years, 5 years, 7 years. This is the 5 in a 5-to-1 ARM. 5 years of a fixed introductory rate. But what happens when that period ends? This is where the adjustable part kicks in. Your note will explain in painstaking detail how your new interest rate will be calculated. It's not arbitrary. There's a formula. And that formula has 2 key parts: the index and the margin. The index is a benchmark interest rate that reflects general market conditions. Think of it as the weather. It changes, it's outside of your control, and it's outside of the lender's control. Common indexes are the SOFR, or the Secured Overnight Financing Rate, or the U.S. Treasury bill rate. Your note will name the specific index your loan is tied to. The margin is the second part. This is a fixed number of percentage points that the lender adds to the index. Think of this as the lender's built-in profit. It never changes. So if the index, the weather, is at 4%, and your margin, the lender's profit, is 2.5%, your new interest rate would be 6.5%. If the index goes up to 5%, your rate becomes 7.5%. The index moves, the margin stays put. Your note is your rulebook for this. It tells you how often your rate can change, usually once a year. That's the 1 in a 5-to-1 ARM. And most importantly, it will detail your safety nets, the caps. An ARM will have limits on how much your interest rate can increase. There's usually an initial cap, which limits how much the rate can jump the very first time it adjusts. There's a periodic cap, limiting how much it can go up in any subsequent adjustment period. And there's a lifetime cap, which is the absolute maximum ceiling your rate can ever hit, no matter how crazy the market gets. Understanding these 3 numbers, the index, the margin, and the caps, is not just important. It is absolutely non-negotiable if you have an ARM. They determine whether your monthly payment stays manageable or balloons into a financial nightmare. So, you have your promise, you have the players, you have the principal mountain you've agreed to climb, and you have the interest rate, the cost of the climb, whether it's a steady, predictable path or a volatile, shifting trail. You now understand the fundamental DNA of your debt. But this just sets the stage. We know the what, the amount, and the rate. But what about the how? How exactly do you pay this colossal sum back over 30 years? How does the bank take your monthly payment, that single check you write, and split it up? How much of your hard-earned money is actually chipping away at that principal mountain, and how much is just feeding the interest? The answer is in a process called amortization, a mathematical magic trick that front-loads your interest payments for years, sometimes decades. And in the next part, we are going to pull back the curtain on that trick. We will follow the money and build your amortization schedule from scratch so you can see for the first time where every single dollar of your payment truly goes. What we uncover might just change the way you think about your mortgage forever. So let's pull back the curtain. To understand the financial engine of your mortgage, we only need 3 key numbers, the holy trinity of your loan, all found right on your promissory note. First, the principal balance, the total amount you borrowed. Let's use a realistic example. $400,000. Second, the interest rate, the annual cost of borrowing that money. We'll say it's 6.5%. And third, the loan term, how long you have to pay it back. The classic is 30 years, which is 360 months. $400,000. 6.5%. 360 months. With just these 3 numbers, the bank's computers perform a single critical calculation. They solve a puzzle. The puzzle is this. What is the one single fixed monthly payment that, if paid consistently for 360 months, will pay back the entire $400,000 plus all the interest that accrues along the way, so that the balance hits exactly 0 on the final payment? That answer is your principal and interest payment, or P&I. For our example, that magic number is $2,528. Now you might be thinking, my mortgage payment is higher than that. And you're probably right. That's because your total payment, the one you actually write the check for, also includes things like property taxes and homeowner's insurance, which we call escrow. We will dissect escrow in a later part, but for now we must ignore it. Escrow is just your money being held for you. It has nothing to do with the loan itself. The P&I, that $2,528, is the core of your mortgage. It's the real payment to the bank. And this is where the story gets interesting. Because while that payment amount stays the same every single month for 30 years, what happens inside that payment changes dramatically over time. This is the secret hiding in plain sight. Let's follow the money for your very first payment. You've just gotten the keys, you're excited, and you send in your first check for $2,528. Where does it go? The bank doesn't just subtract it from your loan balance. Oh no. Before they do anything else, they pay themselves first. They calculate the interest you owe for that month. Here's how they do it. They take your outstanding loan balance for $100,000 and multiply it by your interest rate, 6.5%. That gives you the total interest for a year. Then they divide that by 12 to find out how much interest you owe for just 1 month. So, $400,000 times 0.065 divided by 12. The answer is $2,166.67. Let that sink in for a second. Of your $2,500 payment, almost $2,200 of it wasn't a payment on your loan. It was the fee you paid to the bank for the privilege of borrowing their money for the last 30 days. It was pure interest, pure profit for the lender. It did absolutely nothing to reduce your debt. So what's left? Your total P&I payment was $2,528. The bank takes its interest of $2,167. The leftover amount, a mere $361, is all that goes toward paying down your actual loan. That's the principal part of your payment. After all that, your new loan balance isn't $400,000 minus your $2,500 payment. It's $400,000 minus just $361. Your new balance is $399,639. You just made a payment of over $2,500, and your debt only went down by $361. Welcome to the power of amortization. It's a process that is heavily front-loaded with interest. In the early years of your loan, your payments are overwhelmingly interest. You are barely making a dent in what you actually owe. It's like trying to drain an ocean with a teaspoon while the bank is standing there with a fire hose. Now let's look at month 2. Your payment is still the same, $2,528, but your loan balance is now slightly lower. So, the bank runs the same calculation but on the new, smaller balance. $399,639 times 6.5% divided by 12. The interest this month is $2,164.74. See that? It's about $2 less than last month. Because the principal was a tiny bit lower, the interest charge is a tiny bit lower. So what happens to that extra $2? Since your total payment is fixed, that $2 now gets applied to the principal. The bank takes its interest, and the leftover amount this time is $363.26. Your principal payment went up by $2. Your new loan balance is now $399,275. And this is the pattern. This is the entire story of your mortgage in miniature. Every single month for 30 years the same dance happens. The interest portion of your payment slowly, almost imperceptibly goes down. And the principal portion slowly, almost imperceptibly goes up. In the first few years the change is minuscule. You're still paying thousands in interest every month. After 5 years of payments, that's 60 payments, a total of over $150,000 paid out of your pocket, you will have paid down less than $30,000 of your original $400,000 loan. The other $120,000? Vanished. Gone. Pure interest. This process continues month after month, year after year. The scale only begins to tip in your favor much later in the loan. In fact, you won't reach the crossover point, the month where more of your payment is going to principal than to interest, until year 18. For 18 years, the bank's portion of your payment is bigger than yours. Now for the number that truly matters. The one they bury on page 3 of your closing disclosure. If you follow this schedule perfectly for all 360 months, making only the minimum payment, how much will you have paid in total? Well, you paid $2,528 every month for 360 months. The grand total is $910,080. You borrowed $400,000 to buy the house, but you will pay back over $910,000. That means you will pay $510,080 in pure unadulterated interest. You are paying more in interest than you paid for the house itself. You essentially bought your house and then you bought the bank a house too. This isn't a scam. It's not illegal. It's just math. It's the fundamental business model of banking, laid out in black and white in a document you signed. The entire system is built on the assumption that you will follow this 30-year path, paying them the maximum amount of interest over the longest possible time. This 360-month grid, this predetermined financial journey, is your amortization schedule. It is the bank's map for your money. So now you see the map. You see the 30-year path the bank has laid out for you. But what if I told you that you don't have to follow it? What if there was a way to strategically short-circuit this process, save tens, or even hundreds of thousands of dollars in interest, and own your home years faster without having to win the lottery? In the next part, we're going to talk about the most powerful and most misunderstood clause in your entire mortgage note, the prepayment privilege. It's your secret weapon, your financial superpower, hiding in plain sight within the dense, boring text of your mortgage note. Most people skim right past it, completely oblivious to the fact that they're ignoring a key that could unlock tens, even hundreds of thousands of dollars, and shave years off their financial sentence. This clause, the prepayment privilege, is the single most powerful tool you have to fight back against the relentless march of compound interest. So what is it? In the simplest terms, it's your contractual right to pay more than your minimum monthly payment without being punished for it. It sounds basic, right? Almost obvious. But you have to remember, banks make their money on the interest you pay over the long haul. Their entire business model is built on you taking the full 30 years to pay them back. In the past, and even with some non-traditional loans today, lenders would include a nasty little surprise called a prepayment penalty. This was a fee they would charge you if you tried to pay off your loan too early. It was their way of saying, hey, we were counting on 30 years of interest from you. If you leave the party early, you have to pay a cover charge on your way out. The prepayment privilege is your shield against that. It guarantees your freedom to attack your debt ahead of schedule. But here's where nearly everyone gets it wrong. Here is the critical mistake that turns this superpower into a useless party trick. Most people think, great, I got a small bonus, I'll just send an extra $500 to my mortgage company this month. They make the payment, feel good about themselves, and assume that money went to work chipping away at their loan. But it probably didn't. You see, unless you give your lender specific instructions, they will often do the most self-serving thing possible. They'll take your extra $500 and simply apply it to your next payment. They treat it as a prepayment, not a principal payment. So, if your payment is $2,000 and you send $2,500, they'll apply the $2,000 to this month's bill, and then hold the extra $500 and apply it to next month's bill, meaning you'll only owe $1,500 next month. You haven't actually reduced your loan balance by an extra cent. You haven't saved a single penny in interest. All you've done is given the bank an interest-free loan for a few weeks. You're not paying the loan down, you're just paying it ahead. And there is a world-shattering difference between those two things. To unleash the true power of prepayment, you have to use the magic words. When you send in extra money, whether it's $50 or $5,000, you must explicitly designate that the additional funds are to be applied directly to the principal balance. You need to write it in the memo line of your check. You need to select the principal-only payment option on their website. You need to call them and get verbal confirmation. Whatever it takes. Apply to principal. These 3 words change everything. Why? Because your interest is calculated based on your outstanding principal balance. The lower the balance, the lower the interest charge. Every single dollar you apply directly to principal is a dollar that stops accruing interest for the rest of the loan's life. It's like taking one of the bank's little money-making soldiers off the battlefield forever. A regular payment is mostly interest in the early years with a tiny bit going to principal. But a principal-only payment is a targeted strike. It's 100% pure debt destruction. Let's see what this looks like in the real world. Let's invent a homeowner, we'll call her Jessica. Jessica has a $400,000 mortgage at a 6.5% interest rate for 30 years. Her monthly principal and interest payment is about $2,528. If she just makes that standard payment every month for 30 years, she will pay the bank a soul-crushing $510,000 in interest alone. That's more than the entire value of the loan she took out. The bank will more than double its money on her loan. But Jessica is smart. She's decoded her mortgage note. She decides she can squeeze an extra $200 out of her budget each month. Maybe she cancels a few streaming services and packs her lunch a couple more times a week. It's not a huge sacrifice. But instead of just sending a bigger check, she makes sure to designate that extra $200 to be applied directly to principal every single month. What happens? The results are not small. They are life-altering. By paying just that little bit extra, the price of a decent family dinner out, Jessica will pay off her entire mortgage in 23 years and 4 months. She will completely eliminate the last 6 years and 8 months of payments. She gets to be completely debt-free almost 7 years earlier. And the interest savings? By doing this, she will save over $110,000. Let me repeat that. For $200 a month, she puts $110,000 back into her family's pocket, not the bank's vault. That is the power of attacking the principal. And you don't have to be rigid about it. There are so many ways to do this. There's the roundup method. If your payment is $2,528, just pay an even $2,600 every month. That extra $72 goes straight to principal. It feels like almost nothing, but over 30 years, that tiny change will save you over $20,000 in interest and knock more than a year off your loan. Then there's the famous bi-weekly payment plan that you see companies advertising. They'll charge you a fee to set this up, but the secret is you can do it yourself for free. The magic of a bi-weekly plan isn't paying every 2 weeks. The magic is that by paying half your mortgage every 2 weeks, you end up making 26 half payments a year, which is the equivalent of 13 full monthly payments. You're sneaking in 1 extra payment per year. You can get the exact same result by just taking your monthly payment, dividing it by 12, and adding that amount to your principal payment each month. No fees, no middleman, just pure savings. And my favorite, the windfall method. Get a tax refund? A bonus from work? A small inheritance? The temptation is to go buy a new TV or go on vacation. But imagine taking $5,000 from that tax refund and making a one-time principal-only payment. On Jessica's $400,000 loan, that single $5,000 payment would save her over $15,000 in future interest and shorten her loan by almost a full year. Is a new TV worth $15,000? Now, before you get too excited and start sending all your savings to your lender, you need to do one thing. Go back to your note and look for that prepayment penalty clause. The good news is that for most standard, conventional loans today, especially for a primary residence, they are illegal or very rare. But some loans, particularly subprime or certain portfolio loans, might have one. It will typically only apply for the first few years of the loan, maybe 2 to 5 years. It will be clearly stated. You need to know if you have one before you make a large lump sum payment. For most of you, this won't be an issue, but you have to check. It's part of being a responsible homeowner. Understanding this one clause fundamentally changes your relationship with your mortgage. It ceases to be this terrifying 30-year monster living in your mailbox. It becomes a strategic game that you can actually win. Every extra dollar you send to principal is a move on the chessboard. It's you telling the bank, no, you don't get to have 30 years of my income. You don't get to make $500,000 off of me. I'm taking my freedom back $1 at a time. It's a profound psychological shift from being a passive debtor to an active wealth builder. You now have the key to paying off your loan principal faster than you ever thought possible. But what about the other part of your monthly payment? The part that isn't for the bank at all, but that they control with an iron fist? I'm talking about your escrow account for taxes and insurance. In the next part, we're going to pull back the curtain on this mysterious slush fund, show you how to make sure you're not overpaying, and even reveal how you might be able to get rid of it entirely. So let's talk about that escrow account. For most homeowners, it's just a line item on their statement, a financial black box where money disappears each month, only to reappear in the form of paid tax and insurance bills. It feels convenient but also a little unnerving. You're handing over a significant chunk of your money to your lender, trusting them to manage it properly. But are they? And is this forced savings plan actually the best deal for you? Think of your escrow account as a separate savings account that your lender controls. Every month, when you make your mortgage payment, it's not all going towards your loan. A portion is your principal paying down what you owe. A portion is interest, the lender's profit. And a third portion is siphoned off into this escrow account. The lender then uses the money in that account to pay your property taxes and your homeowner's insurance premiums on your behalf when they come due. Why do they do this? It's not out of the goodness of their hearts. It's about protecting their investment, which is your house. If you fail to pay your property taxes, the local government can put a lien on your property that is superior to the mortgage. In a worst-case scenario, they could even foreclose and sell your house to collect the back taxes, wiping out the bank's claim entirely. Similarly, if your house burns down and you don't have homeowner's insurance because you forgot to pay the bill, the bank's collateral, the asset securing their massive loan, literally goes up in smoke. The escrow account is their insurance policy against your potential forgetfulness or financial hardship. It ensures the two most important bills that protect their collateral get paid on time every time. So, how do they figure out how much to take? Starts with a simple calculation. They take your total estimated annual property tax bill, add your total annual homeowner's insurance premium, and divide that number by 12. For example, if your annual taxes are $3,600 and your insurance is $1,200, that's a total of $4,800 a year. Divide that by 12 and you get $400. So, $400 of your monthly payment would be diverted into your escrow account. But here's where it gets tricky, and where most of the confusion and frustration comes from. This is not a set it and forget it number. Property taxes go up, insurance premiums go up, and your lender doesn't like surprises. So by federal law, specifically the Real Estate Settlement Procedures Act or RESPA, they are allowed to keep a cushion in your escrow account. This cushion can be up to 2 months' worth of your estimated escrow payments. In our example, that's an extra $800 they can legally keep in the account as a buffer, just in case taxes or insurance costs rise unexpectedly. This is why your mortgage payment can, and often does, change from year to year, even if you have a fixed-rate mortgage. Once a year, your lender will conduct what's called an escrow analysis. They look at what they projected you'd need for the year, what they actually paid out, and what they project you'll need for the next year. This analysis is the source of the dreaded "your payment is going up" letter that sends homeowners into a panic. Let's walk through a real-world scenario. Let's say in year 1 everything went as planned. They collected $400 a month, paid your bills, and maintained that $800 cushion. But then, your local property assessment changes, and your tax bill for year 2 jumps from $3,600 to $4,200. That's an extra $600 for the year. Now the lender's math is all wrong. First, they have to pay that higher tax bill, which eats into the cushion they were holding. Second, they look ahead to year 3 and realize they need to collect more money each month to cover the new, higher costs. The new annual total is $4,200 in taxes plus $1,200 in insurance, which is $5,400. Divided by 12, your new base escrow payment is now $450 a month. That's a $50 increase right there. But wait, it gets worse. Remember how that unexpected tax hike ate into your cushion? Your account is now running low. You have what's called an escrow shortage. The lender needs to make up that shortfall to replenish the account and restore the legally required 2-month cushion. They typically give you 2 options. You can either pay them a lump sum to cover the entire shortage at once, or they'll spread that shortage amount over the next 12 monthly payments. Most people choose the second option. If the shortage was, say, $600, they'll divide that by 12, which is another $50 per month. So now, your new monthly escrow payment isn't just the $450 to cover the new costs. It's that, plus the $50 to cover last year's shortage. Your total escrow payment has jumped from $400 to $500 a month. And just like that, your stable fixed-rate mortgage payment has increased by $100, leaving you confused and angry. This is the #1 reason homeowners get that gut punch feeling when they open their mail. Feels like a bait and switch. But now you know the mechanics behind it. So what can you do? First, read your annual escrow analysis statement carefully. Don't just look at the new payment and get upset. Look at the line items. Did they correctly input your new tax bill? Is the insurance premium accurate? Mistakes happen. Clerical errors can and do cost you money. If something looks off, call your lender immediately and ask for a detailed explanation. Second, be proactive. When you get your property tax assessment for the year, look at it. If it went up significantly, you know an escrow increase is coming. You can start setting aside a little extra money so it's not a shock. The same goes for your homeowner's insurance renewal. If your premium increases, you can bet your mortgage payment will follow. Sometimes the opposite happens. Maybe you shopped around for homeowner's insurance and found a cheaper rate, or your property taxes went down. In this case, your escrow analysis might reveal a surplus. If the surplus is less than $50, the lender can just credit it towards your future payments. But if it's more than $50, they are required by law to cut you a check for the entire surplus amount. Getting that check in the mail is one of the small, unexpected joys of homeownership. Now for the big question we promised to answer. Can you get rid of this thing entirely? The answer is, in many cases, yes. This is called an escrow waiver. However, lenders don't just grant them to anyone. They want to be sure you're a responsible borrower who will pay the bills on time. Typically, you need to have a certain amount of equity in your home. The most common threshold is 20% equity, meaning your loan-to-value ratio is 80% or less. Some lenders might have other requirements like a perfect payment history for the last 12 months. If you meet the criteria, you can formally request an escrow waiver. If they approve it, your monthly mortgage payment will drop significantly because you'll only be paying principal and interest. But this new freedom comes with a massive responsibility. The bank is no longer holding your hand. You are now solely responsible for saving up and paying those huge property tax and homeowners insurance bills yourself. Property taxes are often paid semi-annually, and insurance is usually an annual premium. This means you could be facing two separate bills for thousands of dollars each. The big pro of waiving escrow is control. It's your money. Instead of letting it sit in the lender's no-interest account, you can put it in a high-yield savings account and earn interest on it all year long. You have more cash flow month to month. The con is the risk. It requires serious discipline. If you're not a great saver, or if you're tempted to spend that extra cash flow each month, you could find yourself in a nightmare scenario when a $3,000 tax bill arrives and you don't have the money. Forgetting to pay can lead to fines, liens, and even foreclosure. So should you do it? If you are financially disciplined, have a solid budget, and are comfortable managing large and frequent bills, waiving escrow can be a smart financial move. But if you value the simplicity and forced discipline of having it all handled automatically, then keeping the escrow account is probably the safer, more stress-free option. You've now demystified the escrow account. You know what it is, why your payment changes, and how you might be able to take back control. But there's another part of your monthly payment that might be costing you a fortune, often without you even realizing its true purpose. It's a type of insurance that doesn't even protect you. In the next part, we're going to expose this hidden cost, show you exactly who it benefits, and reveal the single most important secret to eliminating it from your mortgage payment forever. So what is this hidden cost, this ghost in your monthly payment? It's called private mortgage insurance, or PMI. And that name is one of the most misleading phrases in all of finance. Because while it has the word insurance in it, and you're the one paying for it, it offers you, the homeowner, exactly zero protection. Not a dime. If you lose your job, get sick, or can't make your payments, PMI will not help you. It's not for you. It's insurance that the lender forces you to buy to protect them from you. Let's break that down because it sounds crazy, but it's the absolute truth. When you buy a house, lenders see the down payment as your skin in the game. The traditional magic number is 20%. If you can put down 20% of the home's value, the lender sees you as a safe bet. They figure you're so financially invested in the property that you will do everything in your power to never default on the loan. But what if you don't have 20%? What if you have 10% or 5% or even as little as 3% down? That's where millions of Americans find themselves. They can afford the monthly payment, but saving up a massive 20% down payment in today's market is a monumental task. From the lender's perspective, a borrower with a small down payment is a higher risk. If that borrower stops paying and the bank has to foreclose, they might lose money, especially if home values have dropped. So, to offset that risk, they came up with a solution. They tell you, sure, we'll give you the loan with less than 20% down, but you have to buy an insurance policy that pays us back if you default. And that right there is PMI. It's a risk management tool for your bank that you get the privilege of paying for every single month. It's like being forced to buy a security system for your neighbor's house. Now you might be thinking, okay, that's annoying, but how much can it really be? This is where the financial drain becomes painfully clear. PMI is typically calculated as a percentage of your total loan amount, usually ranging from about 0.5% to as high as 2% per year. Let's put that into real dollars. Imagine you buy a $400,000 house and you put 5% down, which is $20,000. Your loan amount is $380,000. If your PMI rate is, let's say, a pretty standard 0.8%, you would calculate it like this: $380,000 times 0.008 equals $3,040 per year. Divide that by 12 and you are paying an extra $253 every single month. $253. That's a car payment. That's your utility bills. That's a huge chunk of your grocery budget. And for what? For a policy that offers you absolutely no benefit. It's pure deadweight cost. Over 5 years, that's over $15,000 out of your pocket, gone forever, with nothing to show for it. It's the financial equivalent of a leaky faucet, a slow, steady drain on your wealth that, over time, adds up to a staggering amount of money. So, the multi-thousand-dollar question is, how do you get rid of this unwanted parasite on your mortgage payment? This is where the game changes. Most people think they're just stuck with it for years and years until they slowly, painstakingly pay down their loan. But you have more power than you think. There are 2 main paths to eliminating PMI, but there's also a third secret path that can save you thousands and cut years off your PMI payments. First, the automatic path. Thanks to a federal law called the Homeowners Protection Act, your lender is legally required to automatically terminate your PMI on the date your loan balance is scheduled to reach 78% of the original value of your home. The original value is key here. It means the price you paid for the house or its appraised value when you bought it, whichever was lower. So, on that $400,000 home, once you pay your loan down to $312,000, the PMI must by law disappear. This is the do-nothing option. It will happen eventually, but it can take a long time, often 7 to 10 years depending on your loan term and interest rate. The second path is the proactive path. The same law allows you to request that your PMI be canceled once your loan balance reaches 80% of the original value. So, on that same $400,000 home, as soon as your balance hits $320,000, you can pick up the phone, call your lender, and officially request to have the PMI removed. You have to be proactive, make the request in writing, have a good payment history, and prove you don't have any other liens on the property, but this simple phone call can start saving you that $253 a month, potentially years sooner than waiting for the automatic cancellation. But now for the secret. The single most important strategy that your lender probably won't tell you about. The first 2 methods are based on the original value of your home. But what happens in a real estate market where property values are rising? What if that $400,000 home you bought 2 years ago is now worth $500,000? This changes everything. Your loan balance might still be high, say $370,000. Based on the original value, you're nowhere near the 80% mark. But based on the current value, your loan of $370,000 divided by the new value of $500,000 gives you a loan-to-value ratio of 74%. You've blown past the 80% threshold needed for cancellation. You have more than 20% equity, not because you paid down the loan, but because the market handed it to you. This is the game changer. You can contact your lender and state that you believe your property has appreciated significantly, and you'd like to request PMI removal based on the home's current market value. They will have a process for this. Typically, they will require you to pay for a new independent appraisal, which might cost a few $100s. But if that appraisal comes back and confirms the new, higher value, they will be obligated to cancel your PMI. Spending $500 on an appraisal to save over $3,000 a year in PMI payments is one of the best returns on investment you will ever find. This is how you take control. You don't just wait for your loan to amortize over a decade. You leverage the power of appreciation to kill PMI in as little as 2 years. Now, a critical warning. This all applies to conventional loans. If you have an FHA loan, you're playing a different game with different rules. FHA loans don't have PMI. They have something called MIP, or mortgage insurance premium. And for most FHA loans taken out after 2013 with less than a 10% down payment, the MIP is for the entire life of the loan. It never goes away. It doesn't matter if your home value doubles. You are stuck with that monthly payment forever. The only way to get rid of FHA MIP is to refinance out of the FHA loan and into a conventional loan once you have enough equity. This is a massive trap that many first-time homebuyers fall into, and understanding this distinction is absolutely crucial. So, your action plan is simple. First, pull out your latest mortgage statement and look for a line item that says PMI or mortgage insurance. If you see it, you know you have a target. Second, do a quick calculation of your loan-to-value ratio based on your original purchase price. Third, go to a site like Zillow or Redfin, look up your address and check the recent sales of similar homes in your neighborhood to get a rough idea of your home's current value. If it looks like you might have 20% equity based on that new, higher value, it's time to make a call. Getting rid of PMI is like giving yourself an instant raise. It's one of the most direct ways to lower your monthly housing cost and free up hundreds of dollars to put towards your other financial goals. But this PMI, this insurance that protects the lender, it brings up an even bigger question. What about the insurance that's supposed to protect you? We're talking about your homeowner's insurance, another major component of your monthly payment. And just like with PMI, millions of homeowners are paying far more than they need to, all because they don't understand one critical section of their policy that could be costing them a fortune. In the next part, we're going to pull back the curtain on homeowners insurance, expose the most common and costly mistakes, and show you how to cut your bill without sacrificing the protection you and your family actually need. Imagine a storm, the kind that rattles the windows and makes you wonder if the big oak tree in the front yard is finally going to give. The next morning you walk outside and your heart sinks. A massive limb has crashed right through your roof, leaving a gaping hole over the living room. In that moment, a single piece of paper, your homeowner's insurance policy, becomes one of the most important documents you own. It's the only thing standing between you and a 5-figure, maybe even 6-figure repair bill. Your lender understands this. That's why, buried in your mortgage note, there's a clause, usually called the hazard insurance clause, that legally requires you to maintain homeowner's insurance for the life of the loan. Let's be crystal clear. They aren't forcing you to do this for your protection. They're doing it for their protection. They've loaned you hundreds of thousands of dollars, and your house is the collateral. If that house burns down or gets wiped out by a tornado, and you don't have insurance, their investment literally goes up in smoke. They see your home not as a place for memories, but as an asset on their balance sheet, and they will do anything to protect that asset. But because you're the one paying the bill, you need to make sure this policy is protecting you, not just the bank. And that's where most people make their first and most devastating mistake. The single most catastrophic error a homeowner can make is underinsuring their dwelling. People look at their policy and see a dwelling coverage amount, say $350,000. They think, great, that's what I paid for the house, so I'm covered. This is a dangerously flawed assumption. Your insurance isn't meant to cover what you paid for the house. That's market value. It's meant to cover what it would cost to rebuild the house from scratch if it were a total loss. This is called replacement cost. And in today's world of soaring material prices and labor shortages, it is almost always higher than your home's market value. Think of it this way. The market value includes the land, the location, the school district, and the neighborhood comps. Your insurance doesn't care about any of that. The land will still be there after a fire. Insurance cares about the cost of lumber, drywall, roofing, copper wiring, and hiring skilled contractors to put it all back together piece by piece at tomorrow's prices. If your dwelling coverage is $350,000, but it would cost $450,000 to rebuild, that $100,000 gap comes directly out of your pocket. You could be forced to take out a new construction loan on top of your existing mortgage, or be forced to build a smaller, cheaper house, or even face financial ruin. You must ensure your policy is for guaranteed replacement cost. It might cost a little more, but it's the difference between being made whole and being left with a smoldering foundation and a mountain of debt. The second mistake is almost the opposite of the first. It's a case of being overcautious in a way that costs you money every single month. I'm talking about setting your deductible too low. Your deductible is the amount you pay out of pocket before your insurance coverage kicks in. A common default is a $500 or $1,000 deductible. Sounds safe, right? A low manageable number. But you pay for that safety in the form of a much higher annual premium. Ask yourself this. Are you really going to file an insurance claim for $800 worth of damage? Probably not. Most homeowners avoid filing small claims because they're afraid their rates will go up. So, if you wouldn't file a claim for less than $2,500 anyway, why are you paying extra every single year for a $1,000 deductible? By raising your deductible from $1,000 to $2,500, you could potentially save 15 to 25% on your premium. That's hundreds of dollars a year back in your pocket. The smart play is to choose the highest deductible you can comfortably afford to pay out of your emergency fund. You treat the insurance for what it is: protection against catastrophe, not a maintenance plan for minor repairs. Now, we've talked about protecting the physical house, but what about protecting your entire financial future? This brings us to the third costly mistake: ignoring your liability coverage. Every standard homeowner's policy includes personal liability protection. This is what covers you if someone gets injured on your property and decides to sue you. The mail carrier slips on your icy steps. A guest child falls off the trampoline. Your dog bites the neighbor. These are nightmare scenarios that can result in lawsuits for hundreds of thousands or even millions of dollars. Most standard policies offer a default of $100,000 in liability coverage. In today's litigious society, that is dangerously inadequate. A single slip-and-fall lawsuit with medical bills and pain and suffering can blow past that limit in a heartbeat. Once that coverage is exhausted, the lawyers will come after your personal assets, your savings, your investments, your retirement accounts, even your future wages. The good news is, this is one of the cheapest parts of your policy to increase. Bumping your liability from $100,000 to $300,000 or $500,000 might only cost you $20 to $40 a year. For even greater protection, you should look into a separate umbrella policy. For just a few $100s a year, you can add an extra $1 or $2 million in liability coverage that sits on top of both your home and auto policies. It is the single best bargain in the entire insurance industry. The fourth mistake is the one that blindsides people after a disaster. It's not knowing what your policy excludes. You assume you're covered for everything, but every insurance policy is a contract full of fine print, and the exclusions are where the ugly surprises hide. The most common and shocking exclusion for most homeowners is flood damage. Let me repeat that. A standard homeowner's policy does not cover damage from floods. That includes storm surge, overflowing rivers, or heavy rain that seeps in from the ground up. You need a separate policy from the National Flood Insurance Program or a private insurer. Similarly, damage from earthquakes is almost never covered by a standard policy. You need a separate policy or a specific add-on, known as a rider or endorsement. Other common exclusions can include sewer backups, mold remediation, and sinkholes. Thinking it won't happen to me is not an insurance strategy. You need to read your policy's declaration page, understand the exclusions, and purchase the specific add-on coverage you need for the risks in your area. So, how do you get the right coverage without breaking the bank? First, bundle your policies. Insuring your home and your vehicles with the same company can often unlock discounts of up to 25%. Second, shop around every few years. Loyalty doesn't always pay. Get quotes from at least 3 different companies. And here's a pro tip. Use an independent insurance agent. Unlike a captive agent who only works for one company, an independent agent works with dozens of carriers. They work for you, not the insurance company, and can shop the market to find the best combination of coverage and price. Finally, ask for discounts. You can get a discount for having a security system for smoke detectors for a new roof, for being a non-smoker, for having a good credit score, or for being claims-free for a number of years. Never assume you're getting the best price. You have to ask. Your insurance policy isn't just another bill you have to pay. It is a shield that protects your single biggest asset and your family's financial security. It's a complex legal contract that you are paying for, so you owe it to yourself to understand exactly what it says. But your insurance premium is just one part of that monthly payment you send to the lender. It's the second I in pity. But there's another part of that payment, the T, that silently drains more wealth from homeowners than almost anything else. It's a cost that can rise dramatically without your consent, And in some states, failing to pay it can cause you to lose your home free and clear, even if your mortgage is completely paid off. We're talking about property taxes, and in the next part we're going to expose how they're calculated, why your bill is probably too high, and reveal the step-by-step process for challenging your assessment and potentially saving thousands. And when I say thousands, I'm not exaggerating. For millions of homeowners, the single biggest error in their entire mortgage payment isn't the interest rate or the principal. It's a hidden overcharge, a phantom fee they pay year after year without question. It's their property tax. Most people see that line item on their statement and just sigh, assuming it's some unchangeable number handed down from on high, as fixed as the laws of physics. But that's a myth. And that myth is costing you money. Your property tax is not fixed. It's a negotiation. And right now, you're losing that negotiation because you don't even know you're in one. So let's change that. Let's pull back the curtain on how this number is actually created. It all boils down to two things: your property's assessed value and the millage rate. The millage rate is the tax rate set by your local government, your city, county, and school district. Think of it as the price of admission for living in your community, funding things like roads, schools, and fire departments. This rate is mostly out of your control. But the other number, the assessed value, that's where the game is played. The assessed value is what the government thinks your house is worth for tax purposes. It's their official guess. And here's the secret: they're often terrible at guessing. Why? Because your local tax assessor doesn't personally visit every single home every year. That would be impossible. Instead, they use something called a mass appraisal system. They feed a bunch of data into a computer model, things like recent sale prices in your neighborhood, building permits, and general market trends, and the computer spits out an estimated value for your home. This system is built for speed and efficiency, not for pinpoint accuracy. It has no idea that your neighbor just installed a $30,000 gourmet kitchen, while your kitchen still has the original avocado green appliances from 1978. It doesn't know that the house down the street that sold for a fortune was professionally staged and completely renovated, while you have a leaky roof and a crack in your foundation. The computer sees your neighborhood, sees your square footage, and makes a broad, often inaccurate, assumption. Studies have shown that anywhere from 40 to 60% of homes in the United States are overassessed. That means there's a better than even chance that you are currently paying more than your fair share. Yet, less than 5% of homeowners ever challenge their assessment. It's one of the biggest financial windfalls people just leave on the table. So, how do you claim it? How do you fight back and make sure you're only paying what you truly owe? You follow a simple step-by-step process. Step 1: become a detective. Your first move is to get your hands on your property's official record. This is sometimes called a property card, assessment record, or property data sheet. You can almost always find this for free on your county assessor's or tax collector's website. Just search for your address. This document is the government's entire case against you. It's everything they think they know about your home. Your job is to find the mistakes. Print it out, grab a red pen, and go through it line by line. Do they have the square footage right? Is the lot size correct? Do they list 4 bedrooms when you only have 3? Do they claim you have a finished basement when it's just a concrete slab and a bunch of spiders? Do they list a deck that the previous owner tore down years ago? Any factual error, no matter how small, is a golden ticket. It's the easiest way to win an appeal because it's not a matter of opinion. It's a matter of fact. You are simply correcting their bad data. Step 2: check your exemptions. While you're on the assessor's website, look for a page on tax exemptions or discounts. These are a goldmine. The most common is the homestead exemption, a discount for people who own and live in their primary residence. But there are often many others. Special exemptions for senior citizens, veterans, disabled individuals, or even for homes with specific energy-efficient upgrades. These are almost never applied automatically. You have to raise your hand and ask for them. Failing to claim an exemption you're entitled to is like voluntarily lighting a $100 bill on fire every single year. Make sure you're getting every single discount you deserve. Step 3: find your comps. This is the most important part. If you can't find a factual error on your property card, your next argument is that the assessed value is just plain higher than the true market value. To prove this, you need evidence. You need to find comparable properties, or comps. These are homes that are as similar to yours as possible, in the same neighborhood with similar square footage, age, and condition, that have sold recently, usually within the last year. You don't need a real estate agent for this. You can use free websites like Zillow or Redfin. Go to the map view, find your house, and then filter for homes that have recently sold. You're looking for your home's less attractive twin. A house just like yours that sold for less than your current assessed value. Let's say the county has your home assessed at $400,000. Your goal is to find 3 to 5 comparable homes that sold in the last year for, say, $350,000, $360,000, and $375,000. This is your proof. You are showing the assessor, with real market data, that their estimate is inflated. Step 4. Build your case file. Now you assemble your evidence like a lawyer preparing for trial. Print out the property cards for your chosen comps. Print the real estate listings showing their final sale prices and photos. Then document your own home. And I mean document everything. Take pictures of anything that makes your home less valuable than those comps. Do you have a cracked driveway? Take a picture. Outdated bathrooms? Take pictures. Peeling paint? Take a picture. Water stain on the ceiling? Picture. You are creating a visual argument that your home is not the pristine palace the assessor's computer model thinks it is. Organize all of this into a simple, clean folder. Your property card with the errors highlighted in red. Proof of the exemptions you qualify for. The listing sheets for your 3 to 5 comps that sold for less. And the photos of your home's flaws. Step 5. File the appeal. This sounds intimidating, but it's usually just filling out a one-page form. On the assessor's website, there will be a section for appeals or challenging your assessment. There's a specific window of time each year when you can do this, usually right after you receive your annual assessment notice, so don't miss the deadline. On the form, you'll state your case clearly and concisely. My assessment should be lowered for 2 reasons. First, the county record incorrectly states my home has 2,500 square feet, but it is actually only 2,200 square feet. Second, my property is assessed at $400,000, but 3 comparable homes within a half-mile have recently sold for an average of $365,000. Please see attached evidence. That's it. You submit the form and your evidence packet. Often, an assessor will review your file, see that you've done your homework, and simply agree to a lower value without you ever needing to speak to a person. If they don't, you'll be invited to a hearing. Don't panic. This isn't a courtroom drama. It's usually a 15-minute meeting in a conference room with a small board of local citizens. You just walk in with your folder, politely and calmly present your evidence, the factual errors, the lower price comps, the photos of your home, and make your case. Stick to the facts. Be professional. The board's only job is to determine a fair value based on evidence. By bringing actual evidence, you are already doing more than 95% of the people who appeal. The potential savings are enormous. A successful appeal doesn't just save you money for 1 year. It lowers your home's baseline assessed value, creating savings that compound year after year, potentially adding up to tens of thousands of dollars over the life of your loan. All for an afternoon's worth of detective work. Once you've wrestled your property taxes into submission, there's another sneaky cost hiding in your escrow account that can balloon without you even noticing. Your homeowner's insurance. In the next part, we'll uncover the secrets to slashing your insurance premiums without sacrificing coverage, and reveal the one question you must ask your agent every single year to make sure you're not getting ripped off. So let's start with the simplest, most powerful tool in your arsenal, your deductible. Think of your deductible as your share of the pain. It's the amount you agree to pay out of pocket before your insurance company steps in and writes a check. The higher you set that deductible, the lower your premium will be. A lot of homeowners are sitting on a $500 deductible because that's what felt safe when they first bought the house. But ask yourself, if a pipe burst tomorrow, would you really file a claim for a $2,000 repair, knowing it could raise your rates for years? Probably not. You'd likely pay that out of pocket. So why are you paying a premium for a deductible you'd never realistically use? Just bumping your deductible from $500 to $1,000 can save you up to 25%. Bumping it to $2,500 could save you even more. The key is to choose a number that's high enough to give you significant savings, but low enough that you could comfortably write a check for that amount in an emergency. It's a sweet spot, and finding it is your first major win. Next up is the bundle. Insurance companies are desperate to get more of your business. They want your home, your car, your boat, your life insurance, everything. And they are willing to give you a massive discount to get it. Bundling your home and auto insurance with the same company is one of the most common and effective ways to slash your costs. We're not talking about a few bucks here. We're talking about discounts that can range from 10 to 30% or more across all your policies. If your car insurance is with one company and your home is with another, you are almost certainly leaving money on the table. Make the call. Get the bundled quote. It's a 5-minute conversation that could save you hundreds, if not thousands of dollars a year. And while you're on the phone with that agent, don't just stop at the bundle. You need to become a discount detective. Ask them to go through a checklist of every possible discount you might qualify for. Do you have a monitored security system? That's a discount. Smoke detectors? Discount. Deadbolts on your doors? Discount. A newer roof? A big discount. Are you a non-smoker? Believe it or not, that can be a discount. Have you been claim-free for the last 5 years? You better be getting a discount for that. Companies don't always apply these automatically. You have to ask. You have to advocate for yourself. Treat it like a game where every discount you uncover is points on the board, and those points translate directly into cash in your pocket. Now let's go a level deeper. These next few are things most homeowners completely overlook. First, your credit score. We talked about how your credit score is the key to your mortgage rate, but it's also a massive factor in your insurance premium. Insurers use a credit-based insurance score to predict how likely you are to file a claim. It sounds crazy, but statistically, people with higher credit scores file fewer claims. It's not fair, but it's the reality of the system. So all those good habits, paying bills on time, keeping credit card balances low, they don't just help you with your lender. They make you look like a golden customer to your insurer. If you've improved your credit score significantly since you first got your policy, you need to let your insurance agent know. It could trigger a reevaluation of your rate and lead to a substantial price drop. Second, and this is a huge one, stop insuring your land. Your homeowner's insurance policy is designed to cover the cost of rebuilding your house from the ground up if it's destroyed. It's called replacement cost. But here's the trap. Many policies are written based on the total market value of your property, which includes the value of the land it sits on. Think about it. If your house burns to the ground, the land is still there. It can't be destroyed by a fire or a tornado. You will never ever file a claim to replace your dirt. So why are you paying to insure it? You need to look at your policy and make sure the dwelling coverage amount is based on the true cost to rebuild the structure, and nothing more. This number should be based on local construction costs per square foot for a home of your quality, not the Zillow estimate of your property. Fixing this one mistake can be a game changer. And that brings us to the one question. The single most important question you need to ask your insurance agent every single year without fail. You've raised your deductible, you've bundled your policies, you've checked your credit, and you've made sure you're not insuring the land. You're feeling good. Now it's time to deliver the knockout blow. You call your agent, and after the pleasantries, you ask this word for word. Can you please rerun my home's replacement cost estimate using the most current building cost data for my area? And then email me the detailed, line item breakdown of that calculation? Why is this question so powerful? Because it signals that you are not a passive customer. You are an educated consumer who demands transparency. The replacement cost estimate is the foundation of your entire premium. It's the big number that everything else is based on. And frankly, it's often inflated. Insurers use software that can be based on outdated material costs, generalized labor rates, or features your home doesn't even have. They err on the side of caution, which means they err on the side of overinsuring you and overcharging you. When you ask for the line item breakdown, you force them to show their work. You'll get a report that details the estimated cost for your foundation, your framing, your roofing, your specific type of flooring, your kitchen cabinets, everything. You can then go through that report and find the errors. Does it say you have high-end granite countertops when you have laminate? Does it list hardwood floors throughout when you have carpet upstairs? Does it calculate the cost to rebuild a 2,500 square foot house when yours is only 2,200? These discrepancies happen all the time. By demanding this report and correcting the inaccuracies, you are directly lowering the core number that determines your premium. You are taking control away from the black box algorithm and putting it back in your hands. This isn't about being confrontational. It's about being accurate. This one question asked annually ensures your coverage matches your reality, and that you are paying for what you have, not what a computer thinks you have. Finally, you can't be afraid to walk away. Loyalty in the insurance world is a myth that costs consumers billions of dollars. Insurers often practice something called price optimization. It means they gradually increase the rates on their most loyal customers over time, betting that you won't go through the hassle of shopping around. Don't fall for it. Every 2 to 3 years, you need to shop your policy. Get quotes from at least 3 to 5 different companies. And make sure you're using both captive agents, who only sell for one company like State Farm or Allstate, and an independent agent, who can get you quotes from multiple carriers you might not have access to. When you get these quotes, make sure you are comparing apples to apples. The same dwelling coverage, the same liability limits, the same deductibles. Only then can you see who is truly offering you the best value. By actively managing your homeowner's insurance, you're not just saving a few $100s. You are directly reducing your PITI, that total monthly housing cost we've been dissecting. It's an active, ongoing part of mastering your mortgage note. You've decoded the interest, the principal, the taxes, and now the insurance. You've taken what was once a single, intimidating payment and broken it down into its components, finding savings and control at every turn. But there's one final piece of the puzzle. We've learned how to manage the note, how to reduce its monthly sting. Now it's time to talk about how to destroy it. In the final part of our journey, we will uncover the strategies to pay off your mortgage years, even decades ahead of schedule, and explore the profound financial freedom that comes when you finally hold that clear title in your hand, free and clear. So how do we get there? How do we take this 30-year marathon and turn it into a 10-year sprint? It's not about magic, it's about math and mindset. The single most powerful enemy of your mortgage is your own extra money, aimed directly at the principal balance. Every dollar you pay over your required minimum is a dollar that goes to war for you. It doesn't just reduce your debt by $1. It annihilates all the future interest that dollar would have accrued over the remaining life of the loan. Let's start with the simplest, most popular strategy: the biweekly payment plan. The concept is beautifully simple. Instead of making one monthly payment, you make a half payment every 2 weeks. Since there are 52 weeks in a year, this means you'll make 26 half payments. And 26 half payments equals 13 full monthly payments. You sneak in one entire extra mortgage payment every single year, without really feeling the pinch. It's a gentle, almost invisible way to accelerate your payoff. On a typical 30-year loan, this strategy alone can shave off anywhere from 4 to 8 years and tens of thousands of dollars in interest. But there's a critical catch. You must ensure your lender applies that extra money correctly. Some banks will simply hold your first half payment until the second one arrives, and then apply it as a single, standard monthly payment. This does nothing for you. You must explicitly instruct your servicer, often in writing, that any funds received beyond the amount due for that month should be applied directly to the principal balance. Don't assume they'll do it. Verify. The next strategy is even more direct: making extra principal payments whenever you can. This doesn't have to be a rigid system. It's about seizing opportunities. Think of it as a financial guerrilla warfare against your debt. Did you get a small raise? Don't just let it get absorbed into your lifestyle. Take half of that new monthly income and add it directly to your mortgage payment. If your payment is $2,160 a month, round it up to $2,300. That extra $140 a month might not feel like much, but it's an extra $1,680 a year attacking your principal. Over time, the compound effect is staggering. And then there are the windfalls: that annual bonus from work, a tax refund from the IRS, a small inheritance. The temptation is always to spend it: a vacation, a new car, a home renovation. And while there's a place for that, consider the profound, life-altering power of aiming that money at your largest debt. Taking a $5,000 tax refund and putting it on a $300,000 mortgage might feel like a drop in the bucket. But it's not. That $5,000 could easily save you double that amount in future interest payments and erase several months off the end of your loan term. It's about choosing a moment of discipline now for a decade of freedom later. As you start making significant headway, you might consider more advanced strategies like refinancing or recasting. Let's clarify the difference because it's crucial. Refinancing is like getting a whole new mortgage. You replace your old loan with a new one, ideally with a better interest rate or a shorter term, like going from a 30-year to a 15-year loan. A 15-year mortgage has a higher monthly payment, but the interest rate is usually lower, and you build equity at lightning speed. You'll pay dramatically less interest over the life of the loan. It's an aggressive, powerful move if your income can support the higher payment. Recasting or reamortizing is different and less common, but incredibly useful. Let's say you receive a large sum of money, say $50,000, and you apply it directly to your principal. You can then ask your lender to recast the loan. They will recalculate your monthly payments based on the new lower principal balance, spread out over the remaining original term of your loan. Your interest rate and loan term stay the same, but your monthly payment goes down. This can be a fantastic way to improve your monthly cash flow while still having made a huge dent in your debt. It's a strategic option for those who want the benefit of a lump sum payment without committing to a permanently higher payment schedule. But beyond the numbers and the strategies, we have to talk about the why. Why go through this effort? Because becoming mortgage-free isn't just a financial transaction. It's a fundamental shift in your life. It's the moment the ground beneath your feet truly becomes your own. The psychological weight that is lifted is immeasurable. The fear of a job loss, an economic downturn, a medical emergency. It doesn't vanish, but its power to create panic is drastically reduced. Your home is no longer a liability on a spreadsheet. It's a sanctuary. It's your fortress of solitude. Financial freedom isn't about being rich. It's about having choices. When you eliminate your largest monthly expense, you gift your future self an incredible amount of flexibility. You can afford to take a lower-paying job that you're passionate about. You can start your own business, taking the entrepreneurial risk you've always dreamed of. You can invest more aggressively for retirement, supercharging your nest egg. You can travel, you can give more generously. You can help your children with their own start in life without jeopardizing your own security. You buy back your time, your most precious and non-renewable resource. And then one day it happens. You make the final payment. You log into your account and see the number you've been staring at for years, maybe decades, finally read zero. The feeling is surreal. A few weeks later, a thick envelope arrives in the mail. Inside is a document. It might be called a satisfaction of mortgage, a deed of reconveyance, or a release of lien. The name doesn't matter. What it represents is everything. This is the legal instrument, recorded with your county, that officially declares your debt has been paid in full, and that the lender's claim on your property is extinguished forever. Holding that piece of paper in your hands is a profound experience. It's the tangible proof of years of discipline, sacrifice, and focus. It's the period at the end of a long, arduous sentence. You did it. You own your home. Free and clear. No asterisks, no caveats. It is yours. Over these 10 parts, we have journeyed through the heart of the American dream. We've dissected the dense legal language of the mortgage note. We've understood the immense power of the security instrument. We've navigated the treacherous waters of default and foreclosure. And now we've laid out the map to true financial sovereignty. That stack of papers you signed at closing is not your enemy. It is your guide. It contains all the rules of the game. By understanding those rules, you cease to be a passive participant and become an active player, capable of changing the outcome. The mortgage note doesn't have to be a 30-year sentence. It can be a challenge you conquer in 15 or 10 or even less. So I encourage you, when this video ends, to go find your mortgage documents. Look at that principal balance. Don't see it as an insurmountable mountain. See it as a number that you now have the knowledge and the strategy to defeat. Every extra dollar is a step forward. Every smart decision is a victory. The path is clear. The freedom you seek isn't a distant dream. It's a destination waiting for you to arrive, one calculated payment at a time. The ultimate security is not in owning a house, but in owning your home. And that is the foundation upon which you can build any life you can imagine.